Hello, everyone. In this video lecture, we are going to be discussing efficiency ratios. And we will be covering the following skills: working capital management, and the efficiency ratios will be inventory turnover, days in inventory, receivables turnover, days sales outstanding, payables turnover, days payable outstanding, and finally, cash conversion cycle. So let's talk a little bit about working capital management. So the goal for any company is to maximize the efficiency of their operations. And one way that they can do that is by managing their inventory, their accounts receivable, and accounts payable, right? And this can all help a company to improve its earnings, and profits. So in order to find out how efficient a company is, you need to calculate some efficiency ratios that we just mentioned from the previous screen. Once those efficiency ratios have been calculated, you can then calculate a company's cash conversion cycle, right? And this is somewhat related to your personal life and your cost of living. So you need to collect money that is owed to you, your paycheck, in order to cover your day-to-day expenses and bills. And that's your accounts receivable and your accounts payable. So working capital management, the life cycle, there are purchases that are made, and that's an accounts payable transaction. And you want to know, with the efficiency ratios, how long does it take a company to pay its bills? With inventory, you want to answer the question, how long does it take a company to turn over its inventory and turn that into revenue? And then with the collection process, that's your accounts receivable. And that answers the question, how long does it take a company to receive payments from invoices that were sent out? How long does it take for a customer to pay you for goods that you've sold them? So in order to calculate the efficiency ratios, you need information from both the income statement and the balance sheet. On the income statement, you will need 2 years worth of data, and for the balance sheet, you will need 3 years worth of data. So the efficiency ratios, again, it measures a company's ability to use its assets to generate income. And then you have the accounts receivable turnover, inventory, and accounts payable turnover. So for inventory turnover, you're answering the question, how often does a company turn over its inventory in a year and in days? The information comes from the income statement and the balance sheet. And you analyze 2 years worth of data for comparison. So the calculation is cost of goods sold divided by average inventory, and that would give you your inventory turnover. And then your average inventory calculation for days would be the current year of inventory plus the previous year of inventory, ending inventory, averaging that out, dividing it by 2, and then dividing that by 365 days in a year. So it seems a little bit confusing, so let's walk through this. So the first thing we're going to do is we're going to look at the efficiency ratios. So here you see, well, let me back up. So here I have total net sales and cost of sales highlighted in yellow. And then for Amazon, I have inventories, accounts receivable, and accounts payable. And this gives you a glimpse as to where you can find this on the financial statements of a company. Okay, so the first thing that you want to do in inventory turnover is set up your sheet, your worksheet, to have the current year and the previous year, because you want to determine whether the company is doing better or if it's doing worse. To do the calculation, you need the cost of goods sold, which comes from the income statement, and you need the average inventory. Okay, so cost of sales, which is also cost of goods sold, is the first number that we're looking for. So this is the Amazon income statement, and all I'm doing is taking that number and I'm bringing it down here, and I'm taking the 165 and bringing that down here. Now for average inventory, I need 3 years worth of data. So for the average inventory for 2020, what I'm doing is I'm taking 23,795 plus 2497, and I'm averaging that, dividing it by 2, or you can use the Excel function equals average plus these two numbers. For the 2019 number, I'm taking 2019 plus 2018 divided by 2, which gives me 18,836. And these are the numbers that you see here at the bottom of the screen. So now I do my division, right? Cost of goods sold divided by average inventory. So what is this? What do these figures actually mean? So for Amazon, it's telling me that they can turn over their inventory almost 11 times per year, which is an improvement from the 8.79 times per year in 2019. So it looks like they're becoming more efficient with their inventory. Now to do the days in inventory, since we've done our first calculation here for inventory turnover, I take my results and I move them over to another area of a spreadsheet that I've created, and I put my results from 2020 under the current year, and the 2019, I moved that over to 2019. I use 365 days a year, and that's used in the US only. So you're taking 365 and you're dividing that by the results of your inventory turnover, and that will give you your days in inventory, known as DII. So what this is telling me is that Amazon can turn its inventory over every 34, 35 days versus every 41 days, 42 days in 2019. So what do you think that means? Is that getting better or worse? So next on to accounts receivable turnover. This answers the question, how often does a company collect payments from vendors and customers in a year and in days? Again, information comes from the income statement and balance sheet, and you'll need 2 years worth of data for comparison. The calculations are listed here on the screen, but we will go through them step by step. So we start off with the same template that you can create on your own. And we're looking at Amazon's income statement. So for receivables turnover, I need revenue, not cost of sales. So I take the revenue number and I plug it in here, and I take the 2019 number and I plug it in here. And then I need my average receivables. So just like with inventory, I'm going to take 2020 and 2019, add them together, divide it by 2 to get the average for 2020. And then I'm going to take the accounts receivable from 2019 plus 2018, divide that by 2 to get the average, and I plug that in under average receivables. And then I do the division, and I come up with these results. So what this is telling me is that Amazon is receiving payments on average 17 times a year, which is more than the previous year. So again, it looks like they've become more efficient with their receivables. Now to do the days sales outstanding, we're going to do exactly what we did with DII, days in inventory. You take your results from your receivables turnover and you plug them in to another area on your spreadsheet, and everything is going to be divided by 365, and this becomes the days sales outstanding, number of days on average that it takes customers to pay you. So So Amazon paid its bills within 21 days in 2020. So this is on receivables. So this is a little confusing here. So what this is telling me is that Amazon on average received payments every 21 days versus every 24 days, right? So again, what is that telling you about how Amazon goes about collecting money that is owed to them? In accounts payable turnover, is how often a company pays its bills in a year and in days. Again, income statement and balance sheet financial statements are used, and the calculations are pretty much the same. So for accounts payable turnover, this is going to answer the question, how long does it take Amazon to pay its suppliers and vendors? So the calculation is cost of goods sold divided by the average accounts payable. So again, I go back to the income statement and I grab cost of sales, cost of goods sold, cost of sales, cost of revenue, all the same thing, and I plug them in here. And then I go to the balance sheet and I get my averages, right? I take 2020 plus 2019, I divide that by 2, and that gives me my average over here for 2020. And I do the same for 2019 plus 2018 divided by 2, and I plug those numbers in here. And I do the quick calculation. And what this is telling me is that Amazon pays its vendors almost 4 times a year. So it's kind of even, 2020 over 2019, not too much of a change. And then to calculate the days payable outstanding, and this should read DPO, not days in inventory, we want to take our results from payables turnover and plug that in to this side of our Excel worksheet, and 365 divided by the results of my days payable outstanding. This is showing me that on average, Amazon pays its vendors and suppliers every 94 days, and that's the same in 2019, right? So this looks kind of bad, right? Because it's taking them over 3 months to pay their vendors and suppliers, yet the vendors and suppliers pay them much more quickly. And this is something that a company may do intentionally. Intentionally or unintentionally. One, they may have different payment terms with their vendors set up. Sometimes it could be net 30, net 60, net 90. And if on average, the deals that they have with their vendors and suppliers is net 90, they're doing fairly well. But what this is also showing me is that Amazon owes this money out, but they're not paying it. They owe money out, but they're not paying it. They're holding on to that cash for an additional 30 days, which can be, that money sitting there can be invested in really very short-term investments where the company can actually make some more money off of that money, if that makes sense. So this is exactly everything that we've just gone through. So now we want to look at all of our results in one sheet. So I take my days in inventory and I'm comparing this over 2 years, the days sales outstanding and the days payable, to calculate the cash conversion cycle. And the calculation is the DII plus DSO minus DPO, days in inventory plus days sales outstanding minus days payable outstanding. And that will give you the cash conversion cycle of a company. And as we can see here with Amazon, they're working with a negative cash conversion cycle. And that's pretty good for Amazon, right? So this negative number is good. It's an interest-free way to finance its operations. They're selling out and they're collecting their money, but when it gets time for Amazon to pay stuff out, they're taking their sweet time, right? So inventory gets, turned over, 34, 35 times, and day sales outstanding, their vendors are paying them typically every 21 days. But when it comes time for Amazon to pay out, it's taking them almost 3 months. So basically, they're essentially borrowing from their suppliers. So we've gone through a lot in this lecture. So working capital management is a way for a company to measure its efficiency in receiving payments, selling off inventory, and paying its vendors. We've gone through 6 efficiency ratios: accounts receivable, turnover, and days sales outstanding, inventory turnover, days in inventory, accounts payable turnover, and days payable outstanding. And finally, the cash conversion cycle, which are the results from days sales outstanding, days in inventory, and days payable outstanding. And that determines the overall efficiency of an organization.